Hi everyone, in this lesson we're going to talk about inventory from a bookkeeper's point of view. This is an intro lesson, so the goal here isn't to turn you into an inventory expert, it's just to help you understand what inventory is, how to recognize it, how it shows up in the books, and what your role actually looks like in real life. And as always, this resource is linked down below. So what is inventory? At its core, inventory is anything a business buys with the intention of reselling to generate a profit. So this is most common in product-based businesses like e-commerce, retail shops, wholesalers, manufacturers. Now, if a business isn't holding products for resale, like a service-based business, inventory doesn't usually exist. So the first question you should always ask is this business holding onto products with the intention of reselling them later for a profit? If yes, then inventory exists. Now, sometimes people get a little bit confused when they see a transaction come through the books and they're not sure whether it's really inventory or whether it's an expense. So something is typically inventory if it's purchased with the intention of reselling it, it's held for a period of time before it's actually sold, it has value while it's sitting on hand. So think of you have thousands of journals in your warehouse, those journals have value that you're holding on to, and the business expects to earn revenue from it in the future. So because of that future value, inventory is recorded as an asset on the balance sheet. Now, expenses work a little different because they don't have a future resale value. An expense is something the business uses or consumes right away, so things like rent, software, advertising, office supplies. Once the expense is incurred, the value is gone. There's nothing left to sell later. That's why expenses go directly to the profit and loss and reduce profit immediately, while inventory doesn't. Now, a common gray area are service businesses who use materials in order to complete their service. So just because they're buying a physical item and are technically using the item to generate the revenue, it doesn't necessarily mean that it's inventory. A common example is trades-based businesses. Think of an electrician, a plumber, a contractor. These materials are often purchased for a specific job and then used shortly after. So in those cases, materials are usually treated as an expense or a job cost, not really inventory. Materials start to look a little bit more like inventory when the business is holding large quantities on hand or stockpiling items or using the same materials across many jobs. So think of, I'm going to say, an electrician, and maybe they're buying spools and spools of wire, and that wire is going to be used across multiple jobs, then it might be inventory. But if he's buying something super specific, like a light switch, I'm not an electrician, for that specific job, then it would probably be an expense rather than inventory. So the key question to ask is this being held for future resale, or is it tied to a specific job right away? Now let's talk about how inventory is actually recorded. So when inventory is actually purchased, it's recorded to an inventory account on the balance sheet, so it's an asset, and then cash is leaving the bank. But profit doesn't change yet because the business still has something of value. Now, when inventory is sold, revenue is recorded, and then the cost of that item sold moves from inventory into cost of goods sold. So that movement is what allows gross profit to be calculated accurately. So cash is given, the inventory is received. Once it's sold, it moves to cost of goods sold, which allows you to calculate gross profit. Now let's talk about inventory valuation. So there are multiple methods to value inventory on your books. And the reason why we do this is because oftentimes, let's go back to the journals example. Maybe you buy 500 journals at a cost of $2 per journal, and then the next time you reorder, maybe it's $2.50. And now you have sitting in your warehouse some journals at $2 and some journals at $2.50. So how do you record the value of all of the inventory that's sitting there? And when you go and sell products, how do you know which pile to choose from? Do you choose from the journals that are valued at $2 or the ones that are valued at $2.50 or somewhere in between? So there are multiple inventory valuation methods, but the two most common are FIFO, or first in, first out, and weighted average. So these determine the cost used when that inventory is sold. So FIFO assumes the oldest inventory is sold first. So in the journal's example, the $2 journal would be sold first because that was the older inventory. Whereas weighted average uses the average cost of all inventory on hand. So it would take an average of all the journals at $2, all the journals at $2.50, average them together, and then use that to move to cost of goods sold. Most businesses that carry inventory have a separate inventory system or a sales platform that tracks the quantities and cost, and then the accounting system should just reflect those numbers. So the accountant will decide the appropriate method as far as the nature of the inventory, but your job as the bookkeeper is to just make sure the inventory system and the accounting software are aligned and that you kind of understand the basic principles of what's going on. So some common mistakes when dealing with inventory are expensing inventory purchases immediately rather than putting them on the balance sheet, manually posting cost of goods sold without understanding the flow or the process, mixing inventory with supplies or expenses, and then assuming the software just handles it without adequate review. And then inventory does get a little bit more complex when you start dealing with multiple sales channels, currency exchange if you're buying and selling in different states, provinces, countries, manufacturing because you're taking multiple raw inventory pieces, putting them together, and then valuing the new assembled piece of inventory, which is kind of the same thing with bundles and kits. And then also inventory adjustments or shrinkage. So think of things like breakage, spoilage, theft. So this resource just covers the foundation before we can move on to the more complex inventory topics. Now, this is the part we probably care about the most, is what is the bookkeeper's role when it comes to inventory? And the answer to that kind of depends whether the client has a fully automated system or a semi-automated system / manual system. So if the inventory system is completely automated, meaning they have a software that's tracking inventory and it's integrated with the accounting software, so everything is flowing seamlessly, your role would be to check that inventory purchases are being recorded correctly in the system, just a quick review, that the inventory balances look reasonable, that cost of goods sold is flowing properly with the sales, and there aren't any red flags like negative inventory or strange swings. So you're acting more as quality control rather than manually calculating and adjusting inventory. Now, if the inventory system is only semi-automated or more manual, you'll have a little bit more work to do. At month end, or however frequently you would like to do this, you might need to, review the system that inventory is being tracked in, whether that's a spreadsheet, software, any type of report. You might have to use the costing in that reporting spreadsheet system to create a journal entry to adjust inventory and cost of goods sold. So you're not guessing, you're working with information that has been provided by the business, but you will have to enter in those movements from inventory into cost of goods sold. Now, at year end, an accountant will typically require a physical inventory count. And as the bookkeeper, your role will be to take the physical count results that you get from your client, compare them to what's actually in your accounting system, and then post any journal entry that is required in order to make them match. So your goal is to make your accounting software match the reality. So just to make sure, your inventory should reflect what physically exists, not what the system thinks exists. So you are responsible for making inventory inventory is recorded accurately, reviewing the automated systems, posting any adjusting entries when needed, and making sure inventory and cost of goods sold kind of make sense. What you are not responsible for is designing some inventory system. You shouldn't be performing the physical count of inventory. You shouldn't have to choose the valuation method, and you will not have to create any inventory tax strategies. So if inventory is automated, you review. If inventory is semi-manual / semi-automated, your job is to review and adjust. And then at year end, you're just reconciling to reality. And that's it for this introduction to inventory. Again, if you want a copy of this resource, it's linked down below. I'll see you in the next lesson.